Hey folks, so in this video, we're going to talk about options and more specifically covered calls, but we are going to cover some of the basics and we're going to break this into three parts here. So the first part, we're going to talk about options. We're going to talk about implicit value and time value. Second part, we're going to talk about the options Greeks. And third part, we're just going to talk about the different ideas that have to go into deciding a covered call and your strike and your expiration date. So for this first part, we're going to talk about implicit value and time value. And let's just jump right into it. So, here's our example. We're going to look at American Airline. We're going to look at the expiration that expires March 31st, 2023. And we're going to look at the 14th strike, okay? So let's go over here on Webull. We're going to look at the options chain. Right now, I am on the March 31st, 2023 expiration. I'm looking at the 14th strike. I'm looking at the call side. So note right now that American Airlines, the price is actually above this $14 strike. So right now it's $14.43. So what is the actual difference between the stock price and the strike? That right there is your implicit value. Because right now, if we're basically looking at a call of 14, that's in the money. So in the money means that for the call side, it essentially means that we're below the actual stock price. So right now, we already know that this contract right here, at the minimum, it should be worth 43 cents. So everything above 43 cents, that's all time value. So in our formula, let's go ahead and look at our formula. So our formula says exactly that, stock price minus strike. So what is our premium? Let's go back. Let's look at that. Our premium is somewhere between 71 cents and 72 cents. So let's just call it 71 cents, okay? So let's go ahead. Let's input that. So we're going to do 0.71. Always keep in mind that when we're looking at options contracts, this 0.71 is actually $71 because one options contract represents 100 shares. So what we're looking at right here is on a per share basis. So now what is the stock price? Okay, well, the stock price was $14.43. Let's go ahead. Let's input that, $14.43. All right, so implicit value. Now we could calculate that. So we're going to do the stock price minus the strike price, okay? So that's 43 cents of implicit value. Now what is the time value? The time value is essentially the difference. So we're looking at the premium minus the implicit value. So our premium was 71 cents. Now we're going to subtract the implicit value. Now that's 28 cents, aka $28. So what does that mean? Okay, so let's go back and let's look at this. And let's just summarize everything. Now we're looking at this intraday, so the price actually changed by one tick. So now we're actually at $14.42. But let's just pretend that we're back at $14.43. So just to summarize, if we're looking at the 14th strike, we're in the money. So already we know that this contract is at least worth 43 cents because we're in the money by 43 cents. So that means everything above 43 cents for the premium, that is time value. That is the time that we're paying for essentially 10 days because right now is March 21st. So we're paying for 10 days of time. That is the time value. Time value is the difference between the premium and the implicit value, which we calculated. So going back, time value is 28 cents and implicit value is 43 cents. These two portions together make up the premium of 71 cents. So that basically concludes part one. And then we're going to jump into part two. All right, everybody. So now we're looking at part two where we're going to talk about the options Greeks. So if we're looking at delta, this is essentially the change in options value for every $1 move. And if we're looking at gamma, this is the change in delta. Theta is the options value decay for the passing of 1 day. And vega is the change in options price that is independent of changes in stock price or time decay. So we're going to go back and we're going to look at the same example of American Airlines and the same strike, same date. So let's just go back. Let's look at this again. And now we're going to focus on the options Greeks. So if I'm looking at this 14th strike, we can see right here that the delta is 66 cents. So let's just go ahead and let's type that in right there. So Going back here, we're going to type in delta 0.66. So what does this mean? This means if American Airlines, which is currently at $14.43, let's say that this jumps up to $15.43. Well then, what is going to be my new premium? Essentially, this is essentially saying that my premium is now going to be 0.71 plus this delta right here. So delta is essentially the increase in the premium for every $1 move. And if we're looking at puts, then essentially, this is going to be flipped around. So delta is essentially just saying, hey, 66 cents for every $1 is going to be added to the premium. Now, what is gamma? Gamma is a little bit more complex, and we're going to go ahead and we're going to look at gamma right here. So gamma right here at the 14 strike is 0.31. So gamma is going to be the change in delta. So this is what's going to happen. So now let's go ahead and let's say that the stock price is now $15.53, okay? So this means that from this point going forward, oops, I forgot something. Let's go ahead and write down that gamma. So that gamma right there is 31 cents. Let's go ahead and write that down first. So 0.31. All right, so now let's say that $1 stock price went up and we're at $15.43, okay? Now this is what gamma means. Gamma essentially means that if we go up another dollar from this point on, and let's say that stock price becomes $16.43, then our delta is going to change by 31 cents. So that essentially means that our delta is now going to be equals 0.66 plus 0.31. So that is what that means. That means our delta is going to increase significantly. So just keep in mind that these numbers are all kind of in theory, these are all just kind of in theory. It might not actually work out this way. So that's how gamma works out. So gamma is always looking at, after $1 and another dollar, so basically $2 in, how is this going to change the delta? So now let's go ahead and let's look at theta. So theta, as we mentioned, is the options value decay for the passing of 1 day. So now if we're looking at theta, it is minus 0.02. So this is saying for every 1 day that passes by, our options premium is going to go down by 2 cents, or AKA $2. So let's go ahead and let's write that down. So that's 0.02. And we're going to put a minus sign right in front of that. All right, so let's just say that the stock price does not change at all. Okay, let's say 1 day passes and the next day is March 22nd, okay? Let's say the stock price does not change at all. Well, then what's going to happen is, in theory, the premium should go down by 2 cents. So this premium right now will be 69 cents the next day, assuming that the stock price has not changed. It's still stuck at $14.43. So now out of all of this, I think theta is probably the easiest to understand. I think delta is the next easiest to understand. I think gamma is a little bit confusing. So let's cover gamma one more time, okay? Let's just delete all of this information. We're going to cover gamma one more time. So we're going to go back. We're going to look at the strike right here. It's the 14th strike. The delta is 66 cents. So let's pretend that the stock price goes up $1 from where we recorded it. So stock price, let's say, is at $15.43. So by this time, because we went up $1, our delta is 0.66. So that essentially means that our premium is going to go up by 0.66. So we're going to add our current premium plus the delta. Now what this gamma is saying is that, hey, if we go up another dollar from where we are right here, let's say that we go up to $16.43, well then our gamma is going to be added to the delta. So that essentially means that we're going to add this premium plus this delta plus this gamma. So, if we go to stock price of $16.43, which is $2 more than what we recorded it at, our premium is going to go up much higher than what it was at $1. So now we're looking at $2.34 in premium. So that is how gamma works in theory. So I hope that clears things up a little bit. Now we're going to talk about Vega. So Vega is a little bit confusing because it has a lot to do with volatility. So this is what you really need to understand about Vega. So Vega, I wouldn't pay too much attention to the actual numbers here. Just understand that, let's just say that American Airlines, all of a sudden, let's say they came out with this big piece of news and the stock just falls, it plummets $1, okay? Let's just say it plummets $1 to like $13.38. Let's say that they come out with another news piece right after and they say, oh, never mind, we didn't mean that, we didn't mean that. And then the stock price just jumps right back to $14.38. Well, what's going to happen was that during that time period, a lot of volatility happened. So if we all of a sudden dip down to $13.38 and then we rally all the way back up to $14.38, a lot of people are going to say, wow, this is hella bullish. And then they're just going to start buying more of these contracts that are closer to the money. So what you're going to see is you're going to see a little bit more volatility. Now, even though price did not change, the actual premium might be higher because now you're seeing more players jumping into the fray and saying, oh, okay, well, now there's more demand for these contracts. So essentially the Vega and the implied volatility is pretty much just telling you the demand for these contracts and how that is going to actually change the premium on these contracts. So this can be independent of the actual price of where we're at and the actual time decay. So that is pretty much Vega for you. Now, if we're looking at implied volatility in Vega, these things can go up a lot when we're closer to a big event. Like let's say, for example, we're looking at an earnings event. Now, when we're closer to earnings, you're going to see big fluctuations on stocks. Now, I'm sure, during a lot of earnings, you guys have seen stocks fall 10, 20%, or maybe they went up like 10, 20%. So there's a lot going on this one day. So there's going to be a lot of people who are playing options. They're going to either be buying puts or they're going to be buying calls. So just that alone, just knowing that there's a big event going on, you're going to see the options premium go up, even though the stock price has not really gone up at all. So that's pretty much Vega and implied volatility for you. So that pretty much concludes the second part. And then next, we're going to jump into the third part where we talk a little bit more about the ideas that go into covered calls. All right, everybody. So now we're looking at part 3, and we're going to talk about the covered call scenarios here. So this is where things get a little bit confusing. So do try to follow along. I'll try to be as clear as I possibly can. So we're looking at this scenario right here, okay? So the scenario that we've been working on this entire time. So we're looking at this date, we're looking at this strike. We already determined that our premium is 71 cents. We determined our implicit value is 43 cents. Our time value is 28 cents. And we know that our delta is 66 cents. So this premium, if we're selling a call, this premium is pretty much insurance. So let me just go backtrack a little bit and explain what selling a call is. So if I'm selling a call, that is essentially I'm making a bet against my positions. So this is a bearish bet. So this is my way of hedging. So if you're selling a call, this is what goes on. If I sell to open the 14 strike call expiring March 31st, this is essentially what this contract is saying. It's saying, hey, if by March 31st, the stock price is over $14, I need to sell my 100 shares at $14 and I get to pocket the premium of 71 cents. So that is essentially what this contract means. So it's important to understand the terms of the contract, and this is the terms of the contract. Now there's a second part to this contract. So this second part to the contract says, hey, if by March 31st, the stock price is below $14, I pocket all the premium. So that's pretty much what that's saying. So in this second scenario, that's not necessarily a good scenario because it depends really where the stock price ends. So now, we could create a scenario. Let's say that by March 31st, AAL, which is American Airlines, closes at $14. $14.20. Okay, well, what does this mean? Okay, so this means that we have to sell our 100 shares. So we sell our 100 shares at $14. We pocket the 71-cent premium per share. Okay, so this is essentially the same thing as us selling it at $14.71. Okay, so what is the difference between $14.71 and $14.20? So $14.71 and $14.20, that's 51 cents. So if we're multiplying this by 100, we made $51, okay? That's how that works out. Now, what if there's a different scenario, okay? What if by March 31st, AAL closes at $13.90, okay? So what happens in this situation? Well, in this situation, we pocket 71 cents per share. So all of the premium that goes in our pocket. So what does this actually do for our share basis? Well, our share basis now goes down by 71 cents. So if we purchased at $14.43, our new basis becomes $13.72. So we pocket 71 cents per share, and our new basis is $13.72. So that's a situation right there. So that would be a pretty decent scenario because the stock price closed at $13.90. So we're still above. So that essentially means that, hey, if we sell the next day, let's assume that American Airlines is still at $13.90. Well, then we could basically make $18. But here's the bad scenario. Here is the bad scenario. Let's say by March 31st, American Airlines closes at $13. Well, that's not a good scenario because we only got 71 cents of premium. So we only pocketed 31 cents of premium. So now essentially, our basis is at $13.72. The shares are at $13. We lost 72 cents or $72. So that is how that scenario plays out. So this is why the premium is important. The premium is essentially your insurance. So right now we're talking a lot about banks and FDIC insurance. Well, this premium right here, this is your FDIC insurance. You are getting insured for 71 cents per share for downside. So this is your downside protection, 71 cents. If we fall well below that, you're not protected until that amount. So let's say our delta is 66 cents. So let's say the stock price goes down to $13.43. Well, then you get $66 worth of protection, or 66 cents per share. But what happens if the stock price goes down $2? Let's say it goes down $12.43. So delta should have covered you for $1.32 per share. But our insurance premium only gave us 71 cents max. So right there, we lost out. So that is essentially what's happening right there. So this delta right here on a covered call standpoint is saying, hey, for every $1 that goes down, you are insured for 66 cents on the dollar. So that is essentially what that's saying. But you're insured up until this amount right here. So after this amount, you're not insured. You're not FDIC insured after this amount. So that is essentially what that's saying. So this is why sometimes it is important to either close out this contract and form another contract so that you do have more downside protection, or you pick a later date with more premium and you essentially give yourself more protection. Now, if you go deeper in the money, you're going to see that delta is higher. So your insurance for every $1 down is going to be higher. So let's go ahead. Let's look at the options chain. Now, let's go down to $10. So look at $10. If we're looking at the $10 strike, your premium is going to be much, much higher because there's more implicit value that is going into this. Look at your delta. You're pretty much insured 98 cents on the dollar. So if American Airlines falls by $1, you are insured 98 cents up until $4.48. So basically, this stock can fall about $4.50, and you would be fully insured. But then after that, you would not be insured. That is essentially what this is saying. So let's go out to a further date. Let's just pretend we go all the way out until November 17th. So let's look at the same strike. So if we're looking at the same strike, this is now $2.61. So if we're actually taking the mid, that would be something like $2.63. So let's just go ahead and do that. So we're going to do $2.63. We're going to go ahead, we're going to plug that in. We're going to look at the same strike. So 14, $2.63. That is our insurance, aka our premium. Now the stock price, let's say that it's the same. Okay, let's say it's $12.43. Now, what is the implicit value here? Well, the implicit value, which we remember, is the stock price minus the strike. So right here, we're going to do the stock price. Oops, I actually meant to do a stock price of $14.43. My bad. So let's go ahead and delete that. So the stock price minus the strike price. So right here, minus that. So at this point in time, the implicit value is still the same. Nothing's changed. But what has changed is the time value. So now, we're looking at this formula right here. Time value is premium minus the implicit value. So now we're going to get our premium. We're going to subtract it by the implicit value. You're going to notice that our time value went up significantly. Well, that's because our contract went out further in time. So now there's more variables that could happen between now and November 13th. So we are getting paid more in time value for this premium, essentially. So our premium goes up because there's more time value attached to it. Now, let's go ahead and let's look at all of the delta. So let's go ahead, let's look at the delta. So what is delta here? Delta is 0.64. So you're getting insured 64 cents for every $1 down. All right. So 0.64. All right, so how does this work out? What is our sell price going to be? So our sell price is essentially our strike plus our premium. And then what is our basis price going to be? So our basis price is essentially going to be our purchase price minus our premium. So this is assuming that we pocket all the premium. This is assuming that we get assigned and we have to sell our shares. So this is kind of how things work out. So when you're really picking your strike and your dates, you need to figure out how much insurance do I want and how heavily do I want to be insured for every $1 of downside. So am I comfortable with, for every $1 that goes down, am I comfortable with only being insured 66 cents on the dollar or 64 cents on the dollar? Now you do have to remember that there is a point in time where you can close out your contract. Now, if you close out your contract and you essentially bought to close, so I want to remind you, when you're selling a contract, you're basically writing a call, and this is a bearish strategy. So what you're doing is you're selling to open. And when you want to close out the same contract, you're buying to close. So let's say that, a lot of time went on, but the actual stock price is still around the same. So $14.43. So this is where we go back to that theta component, which is time decay. So essentially, let's say that in the future, let's say that the premium is now, let's say it's $1, okay? So if I wanted to buy to close, then that essentially means that I sold this for $2.63 and I bought it for $1. So that pretty much is saying, hey, you know what? I just pocketed $1.63 in profit. So how that works out is that that is actually a capital gain, and that is going to go show up on your tax return. So that's always something that you need to think about. When you're selling contracts and you're later buying them for a lower price, that's a capital gain, and that's going to show up on your tax. So these are all the different things that you need to pay attention to when you are selling calls. So just to recap this, you want to pay attention, how much insurance am I giving myself? This is like my FDIC limit. And for the delta, how much am I insured for every $1 down? So also with the date, if I go out further in time, there is more premium attached to this. Now, on top of all of this right here, you want to be paying attention to technical analysis. Maybe I want to set my strike price to the resistance, or maybe I want to set my strike price to the support, because these are areas where you're going to see a range. Maybe I want to set my strike price in between support and in between resistance. So these are all the different things that you want to think about. It can get pretty darn complex, but I hope that this is a good start to give you some sort of understanding and some sort of planning when you're thinking about covered calls. So hope you guys enjoyed this video and have a good one.